Hello, International Finance students. So when we last left off, we were talking about or we're about to talk about some of the individual markets, or I guess the aspects of the overall foreign exchange market and the way they, depending on what you're trying to do, might operate a little bit differently. So the first part of that we want to talk about is the spot market. So spot market is the immediate or almost immediate purchase or sale of exchange. So you can buy or take a long position. We use that language, or sell, take a short position in currencies, and naturally you'll do both, right? So if I have U.S. dollars and I'm buying euros, I will take a long position in the other currency, right? So I'm short in the dollar and long in the thing I'm buying. And that relates to what happens to my overall portfolio in the event of a shift, right? So if the dollar increases in value, the fact that I sold off dollars will be regrettable, right? And that would then, since that if I sell dollars to buy euros, that was effectively taking a short interest in dollars relative to my old position. And so that would be a disadvantage if dollars increase in value. But if dollars decline in value, I am glad that I sold my dollars, right? I missed a loss and captured a gain. And, if the dollar falls, currencies are always relative to each other, right? So when I say the dollar falls, you would say, okay, well, the dollar has dropped relative to a basket of other currencies, but the euro almost definitely would be in that basket. So it would usually be true that if the dollar falls broadly, it would fall relative to the euro. And so having a long position in the euro and a short position of the dollar would be net beneficial. So spot rate transactions are it's over-the-counter markets. You solicit quotes. So there's a particular way that we talk about currency quotes because so it would be really strange to say you can buy $1 for 1/7 of a share of Ford, or 1/12 of a share of a Ford, or whatever. $12 to buy a share of Ford, it makes sense, but 1/12 of a share of Ford to buy $1, it's not really how we describe or think about things. But that's a very natural thing to do for currencies. And of course we could, right? We could talk about, the dollar has fallen relative to Ford, which would mean that Ford is more valuable. But it's, that's not how it's usually discussed. But that is how we would talk about it if it was a currency instead of a share of stock. And so if I have, 100 yen to purchase $1, and the yen falls to 140 yen to purchase $1, that makes sense. Just like we could say, well, it's 1 cent to buy, a yen, or it's 0.7 cents to buy 1 yen. That would make sense too, right? And if the yen get cheaper for Americans to buy, we would say the dollar strengthened relative to the yen, or the yen weakened or fell relative to the dollar. So notice that you can kind of talk about the same thing from two different perspectives, right? So if I go from 100 to 140 yen per dollar, that means that the yen has fallen, right? It takes more yen to buy $1. So from the perspective of an American, we would call that an indirect quotation, right? So it is, so as an American, I'm thinking in terms of dollars, but the 140 isn't dollars, 140 is yen. So an indirect quotation is a quotation quoted in the foreign currency you're considering transacting in, right? So again, an indirect quote from the perspective of an American is a direct quote from the perspective of a Japanese buyer, right? So the 140 is the local currency if you're operating in Japan, and it's not if you're operating in the United States. So it's really a matter of perspective. So it's again, it's all relative to where you're talking from. But in general, right, a direct quote is a currency quote quoted in your local currency, and an indirect quote is a quote in the foreign currency. And actually there's some tradition around which currencies tend to be quoted in direct quotes and which tend to be quoted in indirect quotes. And as far as I can tell, the primary driver behind this tradition is that the culture the culture of exchange rate reporting likes numbers bigger than one rather than things less than one. So if, for example, yen, trade at 100 to 1 or 140 to 1, they, and you can kind of make sense from a legibility standpoint. It's sort of, easier to see, well, the yen dropped from 100 to 120 versus the yen dropped from 0.01 to 0.007. And then you also would need maybe more digits to get to the same, I guess you want to represent as significant digits as the same. So 140 or 141 might naturally be 3 significant digits, whereas you're forced to write 0.00743 or whatever it would be. And then maybe there's lots of zeros in front of it. So then it would be maybe 7.43 times 10 to the negative third or whatever. So avoiding scientific notation is nice. So basically from the perspective of American, that means that because the US dollar has a high value relative to most currencies, most American currencies are, most quotes for Americans are in terms of an indirect quote. So as an American investor in a foreign exchange, you see the 140 yen and the, whatever the 7 Thai baht and the 1.3 Swiss francs or whatever it is. The exceptions then are for currencies that tend to be worth more than the dollar. So traditionally that's, so the euro was established at a higher value than the dollar and has maintained that, but to a lesser degree. And then the pound has traditionally been more valuable than the dollar. And there's a couple other exceptions. But right, the Canadian dollar is generally worth less than the American dollar, and so we see quotes. You can think a Canadian dollar quote will be 1.3, and then every once in a while, commodity prices will go up a lot, and then Canadian currency will be worth a lot, and then you have something under 1. So we talk about, I guess, so we direct quotes and indirect quotes from the perspective of an American, just the language of an indirect quote for an American is described as European terms. And then when it's a direct quote, we'd say it's in American terms. So most currencies for Americans are in European terms or indirect quotes, but some are American terms, and the pound is a good example. So your book uses this notation SJ over K to suggest, right, that we're going to buy, right, so the price of 1 unit of currency K in terms of currency J in the spot market. So here's an example. We can see just some data on exchange rates as of, a couple of years ago. And you can see that, many currencies trade at significantly above, that it takes a lot of units of the local currency to buy $1. So the Argentinian peso at this point was 105, and I'm sure it has gotten quite a bit more pesos per dollar since then. The Brazilian real, 5. So the indirect quotes are these large numbers, and then the direct quotes are the small decimals. So there's of course, many currencies to buy. Ecuador is, of course, interesting in that they don't have a local currency. They just use the U.S. dollar as their currency. So they collect taxes in U.S. dollars and pay, government employees in U.S. dollars. Mexican peso, important, 20 pesos to the dollar. So now, right, we can see the Australian dollar with some forward prices. For a long time, the yuan was pegged to the dollar basically 7-1, and it's been drifted. So now the yuan strengthened relative to the dollar after the central bank of China let it strengthen a little bit. So now it's sort of, but so they'll let it float or stay put, depending on what serves the, whatever I guess it's a self-interested decision on the part of the Chinese central bank and the Chinese government, whether they want their currency to float or be stable. So, and this is also kind of just, a list of currencies that are relevant, right? So this in the Americas, you've got these, and then if we're in Asia, Australia, China, Hong Kong, the rupee in India, the rupiah in Indonesia, right? The Thai baht, the Taiwan dollar. I mean, so interest actually, so the etymology of dollar and peso both come from Piece of Eight. That, if you've seen, like Pirates of the Caribbean, they're always, this Piece of Eight. It was just a very popular gold coin that had a lot of success internationally, and so a lot of currencies named their currency indirectly after the Piece of Eight, to help, the more people believe the currency will be useful all over the place, the more people want to own it, the more valuable it is. So currencies are always trying to, brand themselves as being stable and useful. And so it's just in the strategic best interest of countries to name their currency the peso or the dollar all the time. So you see so many pesos and dollars for that reason. And then within, so Denmark, it's the krona, but that's also true in Norway and the Czech Republic, it's the koruna. So you have, these linguistic currency families that tend to use the same thing. But here you can see the euro is actually more valuable than the dollar on a unit by unit basis. So it costs, if you want to buy a $1 US, you need to pay 0.89 euros as of this writing. So we've got, and then the Swiss franc is slightly more than the US dollar. The pound is worth, 30% more, just on a unit for unit basis. Of course, it's really the trend that matters, right? Because if you transact into pounds and the pounds go from being 1.3 to 1.2, it's still more valuable on a per unit basis, but you lost a lot of money because the pound weakened relative to the dollar. Israeli shekel is important. The rial in Saudi Arabia for oil purchases. So there's lots and lots of currencies in the global foreign exchange market, and this is just a sample of what they were trading for not too long ago. So, right. So, one important thing we need to think about is a cross exchange rate. So, a cross exchange rate is an exchange rate between a currency pair where neither is the U.S. dollar. So, think about, if we were going from Thai baht to Australian dollars. So you would think, well, okay, to figure out the exchange rate between the Thai baht and Australian dollars, I would just look at, well, when was the last time someone sold baht and bought Australian dollars? And, maybe look at, 30 of those and then take an average and be good. But that doesn't really work, actually. And that's because, again, getting back to our discussion of liquidity, there will be very little natural demand between, or I mean they're geographically kind of close, but the demand for directly from baht to Australian dollars would be pretty thin. And so it's more efficient to go from baht to US dollars to Australian dollars, which makes the baht Australian dollar market even thinner than it would be otherwise, even fewer transactions. And so in practice, figuring out an actual exchange rate between two foreign currencies, neither of which is the dollar, you route through the dollar. So if I think about, if we are back in the regime where the Japanese yen is 100 yen to a dollar, and we have 1.3 dollars per pound, right? I could say, okay, well, let's say I have 200 yen, I would turn my 200 yen to $2, right? And then I could turn $2 to 2 divided by 1.3 pounds. So that would be, whatever that would be, something like 1.7 pounds. But to actually figure out that number, right, we would have to use the, right, so I would take the 200 that I had, right, my 200 yen. It really becomes a unit conversion problem. So here let me show you how to think about that. If I've got, right, so I've got my 200, right, I've got my 200 yen, right, and I'm going to multiply by, right, 100 yen per $1, right, per $1. And so, and this is like, if you took high school chemistry, this is very similar to this. I will cancel out, right, so I can use my, right, and cancel out these yen, the yen units will cancel. And so I can get a new result where I have, right, 200 divided by 100 is $2, right? So I've moved to $2, and then, right, I would do $2 times, and then we have 1. So I want to get rid of the dollars. So I put the dollars on the bottom. So $1.3 per 1 pound. I'm going to butcher this. It's like a cursive L. A little line there. Okay. And so now, right, I can cancel my dollar symbol and my dollar symbol. But, right, so at the end of the day, I would have 220 over 13 pounds. A little imperfect fraction there. Right, so that's an example of a cross exchange rate, and the key is, right, I think a good way to approach these problems, because it's easy to get turned around of like, well, how do I know whether I divide or multiply? Like, which of all these things do I do? So I think it's really helpful to just write it out this way. So what if I did this upside down, right? So I'm going to go do this upside down. So I said 200 yen. And let's say I do this upside down. So then I have 100 yen and $1. Oops, $1. Okay, so now I'm going to do this multiplication. Well, my yens aren't going to cancel anymore. So now I have 2, 0, 0, 0, right, 4 zeros. So I have 20,000 yens squared per dollar. And that's accurate. That's real. I mean, that's a thing. Those aren't useful units, right? This isn't helping anybody. Yen squared is like just not a useful unit. We're not going to transact in yen squared. So that's, I guess, a way you can just, I guess, step into the darkness a little bit and make an educated guess about which way this should all orient. Kind of see the end from the beginning to say, oh, well, I don't want to hold yen anymore, so I want yen to cancel. I don't want to hold dollars anymore, so I want my dollars to cancel, and just kind of get it to work out. But, as long as you're being diligent about actually, right, this doesn't cancel because I have yen on the top and yen on the top again. So if you're tracking the units, doing careful accounting of the units, then it should help you keep track. Because again, right, this is just a fancy way of multiplying by 1, right? $1 is 100 yen here, and 1 yen is $100. So it's just 1. If I take 7 and I multiply by 1, I still have 7, right? It doesn't change anything. This doesn't change anything. It's just changing some of the units that we're displaying, right? So that's how 200 yen is $2, because we've just done a unit shift. So there's some examples in your assignment for this section. You'll do a conversion between a direct quote and an indirect quote, and a demonstration of a cross exchange rate. Another important thing to talk about is the bid-ask spread. So what is this? When we actually transact currencies, we're dealing with another entity. So on the retail side, you can imagine use your bank. And so what they will do is they'll quote you a price to buy and a price to sell. And of course, they make the money. It's like the house always wins, sort of Vegas style. So when you're buying euros, they cost you $1.26, and when you're selling euros, they net you $1.25. So you're out a penny on the round trip. And so that's how those entities make a profit for manning the phones and actually doing the transactions. Also, because they're operating as right, they just make the market in those currencies. They're not trying to speculatively trade on those currencies. What's going to happen is if they are underpricing the euro, they're going to get a bunch of orders to buy euro, and then they're going to run out of euros and have to go buy more euros, and they'll find out, oh shoot, we should have been charging more. So they get beat up on those trades, and then if the euro raises, then they'll be buying a bunch of them, and then they'll say, oh shoot, we need to sell, and find out they're not getting as much. And so an uninformed market maker is going to very frequently be on the other side of a trade that they're getting taken advantage of. So they have to build in some profit on all the normal transactions when they're not getting bamboozled, and to make it all balance out, right? So there is a transactions cost to handling these currency transactions. They're very, very small relative to things like equities, and right. So an options trade can have a cost to do it that could be 100 times higher than an equity trade, and then an equity trade could have a cost that's 100 times higher than a currency trade. I mean, those aren't unreasonable scales of prices. So it is very, very cheap to trade currency generally, because it's so liquid and they don't move as much as a stock or an option would. So a bid-ask spread is the difference between the bid and the ask. That represents that built-in profit market makers take to compensate for having to transact in a hostile environment. And the bigger the spread, the more profit for the market maker, and the harder it is to transact in that currency. And so right away you can see if you're not transacting in pounds, euros, dollars, or yen, you're likely to be doing a 2-trip transaction, right? So at a minimum, so doing a cross trade between, say, the baht and the Australian dollar is going to very naturally have at least double the transactions costs of a transaction into or out of dollars, and will likely be even higher than that, because as a currency with less volume, those spreads will be higher. So So let's think about an example in the interbank market where you have, a typical transaction is about $10 million. So bids and quotes will be to 4 decimal places, and then they'll quote the hundredth and the thousandth place on the assumption that the ones and the tens place are identical. Right? So we'll sell you the pound for $1.34 and 42 basis points, and we'll sell you for $1.34 and 47 basis points, and buy it for $1.34 and 42 basis points, making a 5 basis point. I say it's not a basis point, I guess, because these aren't percentages, but it's the 4th decimal place deep into this quote. There's a 5. Basically, they're taking a 5-point spread, but it's 4 decimals deep. So the 134 is the big figure and assumed to be known by everybody, and then the last 4 is the small figure. And they just, so if you're working with a dealer, they're just going to tell you the small figure because the big figure is presumably, it will be the same, almost definitely between the bid and the ask. If they were to say, I can give you a 97 to an 03, well, that means, you're just going to assume that the big figure moves up by 1 as it travels from 97 to 03, right? You can imagine, you can sort of infer this from context, what they're trying to say. These are that would be not unusual transactions costs for, right? This is 2 very liquid currencies transacting, so you'd get very low transactions cost to move between them. So a cross rate trading desk would be, right? This is a trading desk that would handle a transaction from one relative, one non-top 3 or 4 currency to another non-top 3 or 4 currency. And so that desk will usually transact through dollars to do that, possibly euros or yen, but most commonly dollars. And then they would handle both, those 2 transactions to get there. And so to calculate the bid, right, that cross rate desk is going to take the bid. So think about trading. So we're going Swiss francs to pounds, right? So that trading desk is going to do the bid on it's going to do the bid on francs to dollars because we want to get out of francs and into dollars. Then it'll do the bid on dollars to pounds because we want to get out of dollars and into pounds. And those 2, that spread will compound, right? You'll have the spread of the one and the spread of the other they'll combine. So now we're multiplying here because we're talking about exchange rates, but those exchange rates are slightly smaller. So you have the 2 spot exchange rates at the bid that multiply, and the 2 spot exchange rates at the ask that multiply. And those numbers will diverge, right? Because those bids will be smaller and the asks will be bigger. And so the more currencies you travel through, the bigger that difference will be generally. So here's a work through example. So this is our, 42 to 47 little number quote. And then we have 37 to 49 little number pound quote. And then a 30 to 35 dollar euro quote, and an 01 to 05 dollar euro quote on the other side. So if we look at, we know from this previous example, right, we need to do francs to dollars and dollars to pounds. So then if we go back here and look here, where's our francs to dollars. I guess this is a pounds. This isn't francs. This is pounds and euros. But right, so we've got our right. So here's our bid. Right, we've got the 42 little number and the 01 little number. That's what we would get. And then on the other side is the right. So then for asks we have the other side, and so we're right. So we multiply. So how do you know? Like, if it's the 13442, we have the 7437, and the 13447 is the 7439. How do you know which one of the 2 do you use? Well, It's easy. I mean, the easy way to do it is you just figure out whichever one you would rather not do, right? So if you're dividing, you want to divide by the big number. If you're multiplying, you would multiply by the smaller number. If you're selling, and then flip all of that if you're buying. So, yeah, there's right. So here's some example. So this is an example transaction, right? So we've got the American bid, the American ask, the European bid, and the European ask for pounds and euros. So and we're doing cross rates. So we're trying to sell pounds for euros. So we're going to route through the dollar. Okay, so we got 1,000,000 pounds. So the first thing we're going to do, right, we got 1,000,000 pounds and we're going to dollars, right? So I need to do pounds for dollars. And so, right, and we want to cancel the pounds. So we're going to now we have two choices, right? The 1333442 and the 13447. Well, which one is going to give us more money? Well, this one will give us more money, which that's the one we're not going to do then, right? So we'll get the bid 13442, get the 13442 represented as dollars. And now, right now we are going now we have dollars, right? So now we need to go dollars to euros. And so we need to get rid of the dollars. So we need dollars on the bottom. And so we want to divide by a number. So do we divide by 0.7437 or do we divide by 0.7439? Euros, right? I'm on the wrong euros, right? Do we divide by 0.8901 or divide by 0.8905? I guess, right? So what are we, right? What are we doing? So we have the 1.3. So we have our $1 million, right? And we're selling $1 million and we're buying euros, right? So, to buy them, we would have to pay more dollars, right? More dollars. And so that means getting less euros, right? Less euros. And so we end up using the smaller number because that's the one that would get us the fewer, right? Between the two, this is going to get us the smaller amount of euros. And so then you can back out the total, right? So we know, right, since we had 1,000,000 pounds and we ended up with 1,196,472 euros, that's going to tell us the effective cross exchange rate. So again, right, so how did we know not to do 8905 and how do we know not to do 13447? You just have to think through like which is the one that benefits me, and then don't do that. And that way the organization you're working with gets to have their little tiny spread that they earn on all these transactions to make up for that hostile transaction environment. So this is selling pounds for euros. So now if we do euros for pounds, so we have euros, we're going to sell euros and get dollars, right? Which means now this is upside down, so we have to divide by this. And so which of the two? Well, we want to divide by a bigger number. So I'm going to use the 8905 now. And plus I'm asking, right? So that's another way to think about it. So I'm going to divide by that 8905. And then down here again, right? I'm trying to go. So I went from euros to dollars, and now I need to go from dollars to pounds. So that means I need dollars on the bottom, which, right, dollars on the bottom is the upside down of this and the upside down of that. So we're dividing by this, which was going to be a smaller, divide by the 47 or the 42. We'll divide by the 47 because they'll make it smaller. And so we end up with this, you get there, and then you get this exchange rate. And so, right, 119,746, whereas in the previous example, we had 119,647. So you get, very similar right? Exchange rates, which again makes sense, right? Those spreads are based on the the combination of the two spreads to get there. Okay, so this sets up an important transaction in foreign exchange markets called triangular arbitrage. So this is when, if you think about having a if there exists, the thing about the big currencies, right? If I'm, there is a liquid active market between euros and dollars and euros and pounds. And so you can imagine, well, if I have dollars, I can just buy euros, or I can buy pounds to buy euros. And those both get me to the same place. Or I can buy pounds to buy euros to buy dollars. Now, typically, that's going to make me lose money, right? Because I lose on the bid-ask spread at each transaction. But if there's some mispricing, or if currencies moved quickly and the dealers didn't update, you can imagine a situation where, I paid, 0.0005%, but they were mispriced by 0.001% on each of those legs. So then I end up ahead on each trip, and I end up with more money than when I started. And since currencies transact really fast, you can take laps with that very quick. So if a triangular arbitrage opportunity exists, you can get very rapid accelerating returns. So kind of a fun sort of a silly example for this was the London Heathrow Airport was having a tough time. So airports many airports and a lot of international locations fund their operations in part through duty-free shops, right? So they get exempted from large value-added taxes that are common in most of the developed world, for the opportunity to then they can sell goods at a markup higher than outside the airport, but lower than what they are after the value-added tax. And so from the perspective of the consumers, they get a better deal after tax. From the perspective of the airport, they get to have larger profit margins, and it's a way to fund airport operations. So duty-free shops are an important part of how airport economics work. So the London Heathrow Airport was struggling because the pound was really, really strong. And so people weren't buying goods in the airport because they were just too expensive. And so the airport decided to do a promotion where they would have a special exchange rate within the airport. And the idea was that you could exchange for more pounds than you would typically be able to. But you had to use it. It wasn't like pounds. It was like a gift card or whatever that you would then go. So you would get more pounds when you went and did the gift card. It wasn't a gift card, but something like it. But what happened is, right, you could exchange, you could do a big note, right? They wouldn't just give you tons of it. If you're like, oh, well, I've only got 100 Deutschmarks. So you would turn over 100 Deutschmarks and they give you however many pounds that is. And then you'd go buy a bottle of wine, and then they would give you change. So they'd give you a whole bunch of, pounds and change. And if you, stepped outside the airport, you could exchange those pounds back to Deutschmarks and actually have more marks than you went in with. Now, it was on purpose to encourage shopping, but what they didn't count on was people buying the wine, going outside, going back to marks, going back into the airport, going back to pounds, buying another bottle of wine, going outside, and the difference was big enough you could actually buy a bottle of wine on the difference. And so people, they got caught because people were walking around with a bunch of bottles of wine, and so it shut it down. But so this kind of so in that case, that was a deliberately set up arbitrage opportunity for the purpose of trying to drive traffic to stores in an airport that wasn't thought through very carefully. But you can imagine how that kind of situation could accidentally happen with, again, these are over-the-counter currency markets. Information sharing isn't great. Prices move quickly. So you could get in this situation where, not enough information has traveled through the system. And for a brief moment, prices are different enough that you could do a pound to dollar to euro to pound and end up ahead of where you were. So so for the assignment this week, we'll do example of that. So here's a work through example, right? So if I have Credit Suisse, now obviously these all have bid asks as well. That just gets to be too crazy. So for our triangular arbitrage problem, we're not going to worry about bid ask spreads, but obviously you have to. But if we just have exchange rates, treat the median of the bid ask as an actual exchange and sort of work with it that way. If we have Swiss francs, right? So in this case, we have a franc for dollar quote from Credit Suisse, a yen for dollar quote from JP Morgan, and a yen for franc quote from a Japanese organization, Japanese bank. All of those need to line up, and they're all different organizations that aren't necessarily talking to each other, that have a whole bunch of currencies they're transacting. So what if these things drift, right? So in this example, right, we have, if I take the Swiss franc exchange rate, right, so this is the dollars to francs and the yen to dollars, you get a yen to franc exchange rate of 124.15, but the Japanese bank was quoting a 125.10, and so these are not equal. So you can imagine what you do, right? So I take, I spend 124 yen and buy a franc, and then I sell my franc for 125 yen and I pocket a yen. So that's, basically a penny. But you can, if I gave them $1 million worth of yen, then you get $1 million worth of pennies, or whatever, because you can do a lot more of these, and you can do it over and over again until those, right, eventually what's going to happen, right, is this Mizuho Bank will notice that they're, bleeding francs, and so they'll raise the franc price, and, Credit Suisse will notice that they're, bleeding dollars, so they'll lower the franc price, and it will all cancel out. But for a time, you would be able to make, a lot of profit doing those three trip transaction, assuming the spreads were small enough. So this is that spelled out, right? I've got $1 million. I buy francs with it at that exchange rate. So I have my $1 million turns into 927,000 francs. I turn those francs into 115 billion yen, and I turn my 115 billion yen into $1,007,000, right? So I took $1 million to make $7,000, but now you have $1.7 million, so you can just do it again, right? So that's kind of the key, is that you wouldn't just do this once, right? You can just take laps on this thing until it disappears. And so we would expect that triangular arbitrage opportunities, if they existed, which they probably do on occasion, don't last very long, because there's going to be lots of trading pressure against this price differential, and it would disappear pretty quickly. This is just an example, like a map of how this would go. Okay, so things to know about the foreign exchange market in terms of how it works on the micro level, on individual transaction level. So some academic work has been done on this. So bid-ask spreads are higher for currencies with more exchange rate volatility, and lower when there's more dealer competition, right? So if there's more people fighting for transactions, you'd have more, and then if there's higher exchange rates, if there's more uncertainty, then you would have, right, again, this is, you don't want to get caught with a big price shift, and so the more the currency moves, the greater the risk to being a dealer of it, and so those exchange rates would go up. So bid-ask spreads are narrowest when London and New York are open, and obviously in widest when they're not, right? So that's when there's a lot of activity going on. Because again, London is the biggest, and then if New York is also open, then you're double covered, and there you go. So yeah, okay. So when we come back, we'll talk about forwards, and I'll work through some quantitative examples.